Welcome to the Master Passive Income Show. My name is Dustin Heiner, and I'm here to help you learn how to quit that JOB, that just over broke job, by investing in real estate so you never, ever have to work a job again. Now, if you're investing in real estate and you're not making a profit, then it's not working. We need to make sure that we are making a profit so that we can then feed our families, we can do whatever we want and buy whatever we want. And I am so excited to have a fantastic guest on. A friend of mine, he's coming to the Real Estate Wealth Builders Conference, going to be teaching this even much more in depth. He is talking about making a profit in your company. It's called profiting first, or profit first, so that you know how much money you're making and you're also baking that in so you're making money. I have an expert here, Rocky Lalvani, on the show. Rocky, thank you so much for being here with me, man.
Thank you so much for having me, Dustin. Excited to chat with you today.
And this is great because you're a real estate investor as well as a business owner. And on top of that, you're smart when it comes to numbers and accounting and how to run a business. Because when you think about when you start investing in real estate, you just buy a property, and if you're flipping, you buy and you flip, and you make money when you supposedly sell the property. And you're like, man, I bought it for $200,000, I sold it for $300,000, and I made $100,000. Well, maybe not. Like, we could look at it further. But talk to us about the profit first type of thinking and how that should be accounted for in our real estate investing business.
So you've heard these principles. I mean, they are timeless. Pay yourself first, right? Again, what you said, if we're going to have a business, if we're going to do real estate, it's supposed to be profitable. The last thing we need is a money pit. And so what profit first is basically a system to ensure that you are profitable. And also just a mindset about how to do things. So it's a lot of this is based on the book by Mike Michalowicz. And Mike is also a serial business owner. He had some 7-figure exits, walked away with tons of money. You know, as all business owners, ego gets in the way. We think we're smarter than we are. And unfortunately, within a couple of years of walking away with 7 figures, he pretty much had to hand over the keys to the house and car, which, you know, as real estate investors, as much as we hate that story, you know, it's business for us, right? Because that's where opportunity comes in. But Mike said, why are we doing this wrong? What did I get wrong? And he realized we have the wrong equation. So your accountant tells you sales minus expenses equals profit, right? But where does that leave profit? It's a leftover. It's an afterthought. Mike said, no, we should do sales minus profit equals expenses. And we take our profit first. So when I do flip deals, you know, the first thing we do is add our profit to the deal. And then we figure out what our expense budget is and whether or not the deal works or what we can offer on the pricing. But it's a very simple, slight change, but it makes massive, massive differences.
Well, if you're baking in your profit before you even buy the property on anything, like for me, with my residential properties, if you're going to buy a single family home, my suggestion is make sure that you're already making $250 a month in passive income before you buy the property. We count that as an expense. And so all that money is just not left over. Like, we make sure that that $250 is accounted for. Same thing with our mortgage, our vacancy factor, our repairs, our property management, our taxes. All that stuff is actually accounted for on top of, are included with your passive income, so that you know you're going to be making that. Now, it seems like as people are getting started in investing, they get all excited about certain things. And maybe it could be appreciation. In fact, I was just talking to another young gentleman. He said, oh man, Dustin, like, I can't really get passive income, so I'm going to go for appreciation. I was like, maybe not. That might be a little dangerous, especially when we see the market as it's changing now. That's going to be kind of pretty problematic. But with that, when we are thinking about having cash flow versus appreciation versus, let's say, tax depreciation, things like that, why should we focus on profit as opposed to maybe appreciation?
Well, I can't guarantee appreciation, right? I don't know if it's going to happen or not happen. We can project it. We can throw a dart at the wall and say, hey, this is what's going to happen. But I can figure out my cash flow. If I've got locked in financing and everything else, I know what my cash flow is. And for the most part, rents don't necessarily decline. Now, if a neighborhood changes, it will. but at least you know up front that you're not throwing money into this property from day one. And I think that's a mistake a lot of people make. They run the numbers, or actually they don't even run the numbers, right? Or they don't include all the things that you mentioned a couple minutes ago. You said um, vacancy, you said maintenance, all those types of things. People forget to include that when they figure out their profit margin, and then they wonder after the fact why they're negative. Now we take this a step further. So you threw all those numbers out and say, well, we have to factor in vacancy. Well, we have to factor in maintenance. Can I ask you a question? How many real estate investors do you know who every month say, I'm going to have a 5% vacancy factor, take 5% of their money and set it aside for vacancy? Or who take, the 10% and set it aside for maintenance?
There are at least the investors that I know, my students, definitely, like, I absolutely coach them. Like, you don't want to be stuck where you are getting credit or, going into credit in a debt to actually pay for something. But there are lots and lots of investors that aren't doing it right, where they would not account for that, or they would think it's there, but they don't actually account for it, or even actually set it aside. They might put it in their numbers, but they don't actually set it aside and have a bank account or something that's literally saying this is itemized out for repairs. So I don't know the ratio, but I would say there are definitely lots of investors that don't do that.
I would say it's the vast majority. Your students are smarter than most because most people don't. This is where we run into trouble. I work with a lot of real estate investors. And once they get on that hamster wheel, they're like, oh, I got cash. I need the next deal. And then 6 months to a year later, they're like, I don't have any cash flow. I'm like, because you locked up all your cash in properties and you have all this equity, but you can't tap it. And now you can't pay your monthly bill. So we encourage people to put the money aside, to put it in a separate account and to keep it there. It's an emotional type of thing. It's not, most people say, oh, I can do this on a spreadsheet. You can, but you're just not going to follow it. We try and do things based on human nature. Humans are kind of weird that way. And so if you put money in a vacancy bucket and it's in a separate account called vacancy, you know that it's there for that purpose. And then when you have a vacancy, you have the money to pull it out and put it in your regular account. And so now you don't have cash flow up and down, right? Because the money was set aside and it's ready for you to handle that particular situation.
Yeah, as opposed to just having a big account for the money that you're going to use for investing, money that you use for repairs, rehab. Like, you just have a big lump sum of that. You can easily dip into that when you shouldn't. You probably shouldn't. So actually, like, repairs, like if you have it in a huge account with everything else, well, there's this next property that looks really, really good. Oh, we got a little bit extra money. Let's go ahead and buy it. Then you kind of get stuck. Now, talk to me about how we can have that passive income now we love talking about having the passive income or the cash flow to help run our business. But then how do we make it so that we live off of that cash flow from that profit that we make from our properties? And how do we make sure that we bake that in so that we could eventually be able to be successfully unemployed?
Well, and so the same way that we talk about having a separate account, to put your vacancy money in, we tell you to have a separate account to take your owner's distributions. And so every month you say, hey, this is what my distribution is from these properties. You move the money into your owner's distribution account. And now you're free to remove the money from the company because you know what you were supposed to get. You put it aside and it occurred. What's happening, though, is if for some reason you can't move the owner's distribution over, you're going to know that there's a problem quickly. What happens when you have that big pile of money is we start spending and we don't realize we've overspent until much, much later. So that comes down to, it's called Parkinson's law, which the amount of time and money allocated to the project will be used up. So let's talk about real estate, right? I have a flip. Well, there's two questions. How fast are we flipping it? And, how much money do I have for my flip budget? Whatever those numbers are, they'll get used up. So if you tell me we've got 3 months and a 50K budget, it'll take 3 months and a couple of weeks, and we'll probably spend 50 grand. But if I came to you and say, hey, I got 30 days to flip this property and I got a 20K budget, I guarantee you we'll do it. And so by constraining yourself in these ways, you use Parkinson's law to your advantage and you figure out how to be more resourceful. Too often we throw money at problems instead of thinking through a solution and figuring out a way to do it for less.
You're 100% right. In fact, I get students from all over the board that have very, very little money, that have a lot of money. And what's really interesting is I have to help my students, I'd say more so, but I have to help the ones that have more money, because what they tend to start thinking is, okay, I could buy this house for, let's say, $90,000. As Midwest, you have decent homes at $90,000. Let's say $120,000, whatever it might be. Let's say it's $100,000. They're asking $100,000. This student has $500,000, like literally cash that they could spend in their 401k, IRA. Like, man, I could just buy it with cash right now. $100,000. I said, stop. No, we're investors. We buy it for less than it's worth. We're not going to pay full price. We're not going to overpay. Like, you need to think that people who start with very little money, they're fighting for every single penny because they don't have extra pennies. And what I try to do with my students that have a little extra money, that have a lot of extra money, I try to help them to realize that definitely a penny saved is a penny earned, but we're investors. If you started, people with a lot of money, they have a huge leg up, but at the same time, it's actually detrimental in that sense where they can just say, it's an extra $5,000. Let's just go ahead and pay it. Like, no, we don't do that, because we have, let's say, our top dollar to buy a house that gets us the passive income that we need of $250 a month. We do not go over that. We don't think, it's just an extra $1,000. Let's just go and throw it in. We don't do that because we are investors.
Very much so. You need discipline. And this whole system is designed for discipline and to really show you what's going on. Because by having the different bank accounts and with a purpose, you know how much money's left over. And so we see this a lot with flippers. If you're doing multiple projects, nobody knows how much money is into what house and where they are on the timeline. Whereas if you take a bucket aside and you call it, 123 Main Street, and there's 30 grand in 123 Main Street, you start to see it go down. You're like, wait a minute, there's only so much left and I still have to do a kitchen and a this and a that. This is about emotional control, because too often people throw money at problems instead of taking the time to figure out a better way to do it.
And I love the idea of being disciplined too, because when you start getting emotions in your investing, that's when you make you make mistakes. Problems come up, you make mistakes because your emotions start running and everything. And I know for me, I don't do stocks because I am horrible with stocks. I get too emotional. Number one, I don't understand it. But number two, I wouldn't say I get emotional. I just think, oh my goodness, it's dropped. I better sell before it goes any lower, which that's probably the best time to keep it. I'm not saying that it is, but I've seen it in my past where I sell, it's the wrong way. If I buy, it's the wrong way, because I'm really good at buying high and selling low, which is the worst way to invest in real estate. Now, what I've done though, is I found somebody. Actually, I'll give him some props because he's a fantastic investor. His name's Gareth Soloway. And what he does is he makes it as systematized, as automatic and robotic as possible. So you remove these emotions. And so if like they call it, I think it's like chart analysis and technicals and all that type of trading. And I make so much money because I listen to him in my stock trading because he takes the emotions out. Same thing with my students. I try to help them because I'm a third party person, meaning outside of their, influence and, their friends and, coworkers and all that sort of stuff. But I've done it before. And on top of that, I've literally done it many times with other students that I can literally take emotions out. I'm like, well, your emotions are telling you this. It's a great property. I spent so much time analyzing it. I want to get it. Like, well, it's not a good property. Like, I wouldn't buy it if I were you. So take that emotion out. Now, how does the profit first system, but like the thinking, how does that help even much more so in creating discipline in your business, as well as like, is there steps that we would need to take, or like principles that we need to implement into our business?
So profit first is basically a cash management system. So after you come up with your numbers and your spreadsheets and you do your due diligence and you pull the trigger and you make the deal, what this does is sit on top of it as a cash management system to give you real time, because nobody opens up their QuickBooks or this or that to say, how much money do I have left? Nobody's got real time accounting in most of these situations. And so this is kind of designed to give you that real time feedback loop of what's actually going on within the property. And it's there to also create your reserves so that you can sleep at night. It's not any longer like, oh, and I tell you this, like you buy a property and let's talk about a rental. You go through the property, go, yeah, this house needs a new roof. Yeah, I think I can get away with 2 years. Great. But we know now that a new roof needs to go on in 2 years. So in 2 years, when it leaks and you need to put a new roof on it, it's not an emergency and a surprise. It's an expectation. Have you planned for the cash flow to get to that point? Have you put aside the money? Now, if you're only clearing $250 a month on that deal, my guess is you're not going to have enough money put aside in 2 years to pay for the roof. So what's your plan for that? How are you going to handle that situation? Again, it's not an emergency. You knew it was going to happen. Same thing, appliances. Like I know with my properties, like if I have rentals, I assume the appliances are going to last 5 years. So now it even comes down to a question is, how many appliances do I want to put in there? And do I price appropriately to cover for it? So it's thinking through all of those types of situations. That's basically, it's just changing the mentality to realize if we're going to spend money, we need to make money, and let's put pen and paper down and let's pencil it out and see what it says. Too often, I think a lot of people, especially newbie investors, get excited about a property, but they don't know how to put the numbers to it.
So is it as simple as creating a bank account that has multiple bank accounts and just separating it out? Do you need be more complicated, like having QuickBooks or something much more like, is it Excel sheet? How is there an easy way to do this, or is it more complicated?
I don't care how you record your money. As a matter of fact, you can just put it in the accounts. You don't even need to. I mean, you should always record your money, because if you're not recording your money when tax time comes, you can't tell them what your expenses are. You can't tell them what's going on. So you should always have some sort of recording system. I don't care if it's Quicken, Excel, QuickBooks, whatever you use, you use. This system sits on top of whatever it is that you're using.
What can you give me an example of somebody that implemented something like this in their business and it really changed the way that either that they ran their business or had extra funds to be able to, go on vacations or something like that?
So I deal with a lot of business owners. Some of them are in real estate, some of them are not. So my guys who aren't in real estate, a lot of them want to get in real estate. So we actually create a real estate account in their business. So they take their profits and they put it in a real estate account so they have the cash to come into a deal on. Most of my real estate investors, here is the dirty truth about it. And there are people out there with 100 doors, 500 doors that if you ask them their numbers, they have no idea where their money is coming and going. And it's the reality. They get excited. They buy a property. They buy 10 properties. They don't put money aside for the vacancy, for the repairs, for all of that. And so for most of these people, it brings them discipline. It allows them to sleep at night because they finally know where their money is going and what their deals look like. And this is not talked about. Everyone looks at these guys and they look great, and they're screaming and they're yelling and everything looks wonderful. But when you actually open up their financials, they're a mess because they haven't done the numbers well. And we see this all the time. It is more common than it is uncommon. Now, you're a smart guy, so I know you wouldn't do anything like this and you teach your students well. But the reality is, for most business owners, this is the reality of it. They're struggling with the money part of it. And then their family suffers and they don't sleep at night.
And that's a sad thing, is if you get to that point where you're just constantly thinking about money. Now, in any property or any business that I create, I look at profit first. In fact, in 2006, when I first started buying properties, I thought, well, I want to quit my job, so I need to make money. That was the first thing. I got to make money. So let me make sure that I'm making money from every single property that I buy. So I didn't even have to think about it. Like I didn't have to hope. It's already accounted for. And with that, when you're thinking about creating this and bringing profit first, like putting this, is it hard to bring this in if you've never done anything like this before?
No, it's easy. And a lot of people think, oh, I have all these bank accounts. It's too many transactions and too hard to keep track of. It's not. It's really it's a simple system designed by an entrepreneur for use by entrepreneurs. And it's designed for what we call bank balance accounting. So most business owners don't look at their QuickBooks, they look at their bank balance. And that's how they make decisions. This system is designed.
Guilty. You're very guilty of that.
This system is designed to use that, I'll call it a bad habit, to your advantage, because now all the bank accounts tell you how much money you have for a specific situation. So let's say you get the call from the tenant, I'm moving out next month. Okay, what's my vacancy account look like? Oh, it's pretty full. I can handle, like, I don't have to freak out that I have a vacancy. What's my maintenance account look like? Do I have the money to pay for the turnover? Yeah, I do. As a matter of fact, I have a lot of money, so maybe we might need to spruce up a couple things. I know I have the money to pay for it. And so it gives you that confidence to make those types of decisions.
And I remember back in 2006 into 2008 when I was first started investing, because I was investing just for cash flow because I want to be able to quit my job and have income coming in. The other investors that I knew, and you hear them all over the news and everything back in 2008, 9, and 10, where everything was collapsing. There were so many companies that were literally going bankrupt because they were either going for appreciation. They didn't know what their cash actually was on hand. They were way over leveraged, whatever it might be, but they weren't not going for this profit and weren't focusing on that and making sure that it's not just focusing, it's baking it into the system before you even do anything. That's the brilliant way about doing this profit first system, is you already have it accounted for. It's an expense, just like your mortgage is an expense, your profit is an expense. So I love it. Now, Rocky, what else? Is there anything that we would need, like if there's a lesson learned that has anybody ever, you jump in with any coaching, what is a lesson learned that we can use to apply this to us?
So the bottom line is this, and I will tell my dirty, sad news about real estate, right? I had my real estate license when I was in college. I was selling real estate. It took me 20 years to buy my first investment property, right? We see the same thing with profit first. People just don't start. I'll do that tomorrow. I'll worry about that some other day. What we tell people is you've got to take the first step. You have to take the leap and you've got to start doing it. And that's literally what it comes down to. Rip the Band-Aid off and make it happen. If you don't take action, you're going to consistently struggle. And the thing that people don't talk about with money is there are a lot of emotional scripts underlying our money. And more often than not, I don't think we want to face them, or we don't even realize that they're there. And so when I talk to people about money, I know that it's more than just, the pluses and minuses on the Excel sheet. It's overcoming the emotions. But yeah, the system works. You just have to figure out how to make it work for you. And then you have to just show up and do it consistently. Right. And that's basically the way it works.
I love it. Man, Rocky, there's so much more. In fact, you actually coach people how to do this. And so you're going to be at the Real Estate Wealth Builders Conference. And if everybody wants to, and if you want to get your ticket, get 10% off your ticket. Use a promo code podcast. Just use that promo code of podcast. Go to rubcon.com, get your ticket. Rocky will be there as well as 30. Actually, Rocky, we literally have 38 speakers now. We have so many speakers that want to come and teach and help all this great. Basically, it's just giving away all this information to help people in the end. So, Rocky, thank you so much. Now, I know people are going to want to. I've been on your podcast. You have a couple great podcasts, but you have great business. You also coach this. How can people find you and reach out to you online if they want to start working with you?
So my website is Profit Comes First, and the podcast, wherever you're listening, is Profit Answer Man. So we literally talk about this all the time, just teaching everything that we do for our clients. And we give it away for free because we realize that there's a group of you who would rather have somebody else do it. And for the rest of you, here's the information. Go implement, have fun, learn, be profitable.
I love it. Man, Rocky, thank you so much. I'm looking forward to hang out again at RubeCon and getting so much great value from you for all the attendees and all the speakers and sponsors. So, man, Rocky, there's so much more to go over, but we're ran out of time. I appreciate you, man. I really thank you so much for coming on the show.
Thank you so much for having me today, Dustin.